To remain updated with the latest business news, click on the bell icon.
This is a really interesting juncture for the stock market because we've had enormous volatility over the last couple of weeks. It's almost as if the market is trying to find its way on which way it will break, because it's been trapped in a range from that high of 18,600. It came and knocked on the doors of around 16,500. And this 2,000 point band has become some kind of a trading and a whipsaw range. It is attempting rallies, but there is supply at higher levels. And every time it comes below 17,000, we are seeing buying support. There has been relentless selling from FIIs, which has brought a lot of companies like HDFC Bank, the ones where FII holdings are very large. Those stocks have come under pressure. But this has always been countered by a very strong wall of money, which is constantly getting in from local or retail investors in India. So it's almost like a balancing process. And that is also showing up in the kind of stocks which are going up and the kind of stocks which are coming down. In fact, so much so that a lot of people these days try to shy away from stocks where the FII holding is very large. So this will give at some point, because one outcome is that the market remains in a 2,000 point Nifty consolidation range for a few more months and remains very volatile within that. The greater chance of the outcome is that one of the ends of this range actually breaks following this volatility. Now, what will determine it could be an event like the Ukraine war. If that becomes a full-fledged war and crude oil prices go on a boil above $100, $110, that could break the market beyond this or below this trading range. The other thing is, if the Fed does something very surprising with a very large rate hike in March, which is not penciled in by the market today, that will almost inevitably lead to a major global correction, and India will not be immune. So these are the major risks: the possibility of a large and a series of rate hikes from the US Fed because they're falling behind on inflation, or something on the geopolitical horizon, which could actually break the market below 16,500, which is a level where a lot of support is coming in right now. So that's why this is such an interesting juncture, because there is a lot of to and fro, and there is a tussle going on between FIIs and domestic investors on which way the market should break out. But either way, whatever happens, I think the next few months would be a time of intense volatility, possibly some downside in the market as well, because valuations are still quite high. And one cannot say after a mere 10% correction that valuations have become very attractive. So be prepared for more downsides, particularly in some of these mid-caps, expensive mid-caps, which have run up quite significantly over the last 1 year or so. Is it a buying opportunity? It could be if you're able to stomach a lot of volatility, because this doesn't appear to me to be the kind of volatility which is marking the end of the bull market. I think it's one of those violent corrections which happen in bull markets, which often tend to be even 20% in size. We are nowhere close to a 20% correction yet. We have just about seen about 8-9%. If this turns out to be a 20% correction, we will go below 15,000 on the Nifty. That is not the base case scenario for most market participants today. If that were to come about, it would be a fantastic buying opportunity. And I don't think even at that level, we should write off the obituary of this bull market. So I think the bull market is alive. This is a sharp correction, but it could be a painful 6 months for the market as we digest the valuation rise of the last 1 year or 1.5 years. And we soak up quite a bit of this global liquidity which is coming into the market in terms of selling. So the one way to look at this market is wait for really bad days to put in incremental money into the market and stagger it over a period of 3 to 5 months, and hope that this correction ends sometime before the end of the year, so that next year onwards, without the threat of any kind of geopolitical disturbance, and having absorbed the first few interest rate hikes from the US and therefore the reset which is going on, you can then restart the trajectory of this bull market with some earnings support under your belt, maybe towards the end of this year or early next year. That should be a good thing to hope for. But for the near term, I think one should fasten one's seatbelts, because there are going to be some ugly days going forward.
If you like the video, do like, comment, share and subscribe.